right now we have a panel coming to share with us some thoughts around strengthening operational resilience and overcoming challenges, the changing face of banking services in the East Africa region. Our moderator for this panel is Dr. Louis Kasekende. I'd like to welcome you up on stage together with all your panel members. Mr. Thomas, Mr. Benjamin, Dr. Habil, and Ms. Mkola from the AfDB. Please, you're most welcome.
Thanks, Moderator. I've been introduced, Louis Kasekende. I'm the Executive Director of MEFMI, the Macroeconomic and Financial Management Institute in Harare. Thanks a lot for inviting me. Habari to all of you in the room and those online. This panel is going to address the changing face of the banking sector. The digital disruptions have changed the face of banking in the region, especially in the last 15 years. It has expanded the reach of financial services in a very unprecedented manner. Fintechs were exploited, you may recall, during the COVID-19 to further and to sustain some payments infrastructure within and even across countries. In a recent forum that we organized as MEFMI, Governor Njoroge informed the participants that the introduction of mobile telephony in Kenya has revolutionized the financial ecosystem, going beyond payments to savings, to insurance, and has tripled access to financial services by adults from 26% in 2006 to 83%. So that's one example, and we shall get more from this panel. However, as we move and transit to digitalization, it has also changed the risk landscape in the financial sector. Regulators are currently faced with challenges of balancing the convenience and outreach within the financial sector on one hand, but also responding to the changing face of the risks landscape. Banks and other providers of financial services now face vulnerabilities associated with this rapid adoption and increased reliance on technology. We will be coming back to this particular subject, I know, tomorrow, but the cyber threats are at a very elevated levels. But in addition, banks face disruptive effects of climate change and macroeconomic distortions related to the gloomy economic developments, the war in Ukraine, and the tighter global financial conditions on the performance of the businesses, on the enterprises, households, and especially their capacity to remain current on servicing obligations. So there is thus need for banks and other financial services providers to effectively monitor the ever-changing risks landscape and design mitigation measures that strengthen the operational resilience and provide protection. So we have a panel. I thought we would be four, but I think one of them is not here. We have Saleh Mkola, Tambwe, the Regional Principal Investment Officer of the African Development Bank. Just, okay. We have Thomas, and I have a big problem with your surname, but I did apologize before I walked in. Thomas is good. He's a Director of Development Strategies for the Rawbank in DRC. And Benjamin Mutimura, Chief Commercial Officer of the Bank of Kigali. Now, I've put together some 3 questions. The first one, Olaka is online. Habil Olaka, the CEO of Kenya Bankers Association. I'm sorry, I hadn't noticed that. So most welcome, and you can also wave to the participants, please. Go ahead and wave. Okay.
Thank you.
I have put together some 4 questions. One is, what are the challenges of economic performance of the region? And what is the current outlook, and how has it affected the performance of the financial sector? The second one is this technological change and how it has transformed the financial sector in terms of efficiency, access, and products, especially for those at the bottom of the pyramid. Some of these segments of the financial sector have boomed well below the regulatory radar of the authorities. To what extent has financial technology enhanced financial inclusion in your country or region? And how have you addressed worries of consumer protection in both the regulated and the non-regulated segments of the financial sector? The third one is the fear in this new financial architecture is especially in the segments that are lightly regulated, is the social and political costs of any failure. How should we address financial regulation to mitigate that particular risk? Then lastly would be the whole issue of the transition from the 90s. In the 90s, we were always looking for subsidies for those who are at the bottom in terms of micro-lending. And if you don't subsidize, then it will only benefit very few. The issue I think now we might have to touch on, how come the experience of fintechs is different, where they are sometimes offering loans for 14 days at 2% for a period of just 14 days. We have 1 hour. I've taken up some time myself. But each of the panelists will be given some 6 minutes to pick on those 4 questions. I've talked to some of them as to where they want to place their emphasis. Saleh wants to go for the macroeconomic environment, and I think that's where we should start. And Thomas has just said that he wants to take on this question on the technological change. Make your pick, and our CEO, you'll also make your pick. I thank you. So, Saleh, your 6 minutes. I will be strict on time.
Thank you very much. Am I audible? Can you hear me? Yes. Just a bit of point of correction. Saleh is my father. My name is Mkola Tambwe. Okay. And as the moderator has introduced me, I'm the Regional Investment Officer in Africa. I'm looking at East Africa at the African Development Bank, focusing on financial intermediation, and I sit in the Financial Sector Development Department. So I'll speak as a practitioner, being an investment officer in the East African Financial Intermediation Office, and basically speak on the trends that I'm seeing amongst my would-be counterparties and present partners. I would not call them clients, present partners that I work with in ensuring that we provide access to finance to the bottom of the pyramid. And I'll begin to speak of the various trends that my colleagues and I have seen in the market, and basically how banks in East Africa are adopting to these particular trends. But before I begin, let me just go to the focus areas. These are basically the countries that we as the Financial Sector Department at the African Development Bank look at. We look at the broader East Africa. However, activities are mainly in 10 particular markets, and these include Djibouti, Burundi, Kenya, Uganda, Tanzania, Rwanda, Ethiopia, those countries. And I must say that the industry in each of these markets is, the industry in general is very diverse, and therefore it's a bit difficult to compare the different markets. But if I were to group them, I would say that Kenya is what stands out in terms of development, whilst Uganda, Tanzania, and Rwanda will probably be, if you were to tier them, it will be the next tier. So most of the banks that we interact with are still grappling with the effects of the corona pandemic. And this had mainly, in terms of operations, mainly has affected the quality of bank assets that were earlier structured and are basically coming back either into the good book or being classified as non-performing. We also see how banks are responding to the Russia-Ukraine conflict, where we've seen a lot of assets, bank assets, or rather loans being affected by supply shocks, as well as the rising costs of commodities, particularly importers. These are, if you look at Tanzania and probably Kenya and Uganda to a certain extent, the majority of the local corporates are importers of either fertilizer or wheat. And we see shrinking demand in terms of demand for loans, as well as gaps in terms of repayment of facilities. Moving on to banks responding to digital transformation, and this I would speak for mainly the tier 1 and the tier 2 banks. A lot of the banks are adopting digital transformation, where we see a bigger focus on banks responding to either mobile money platforms or online payments. And this, I would say, is led by Kenya, where the majority of the tier 1 and tier 2 banks have adopted strategies for digital transformation. And I must mention that there was a big push or acceleration during the pandemic to basically bring a lot of these platforms on board and in use. Linked to the digital transformation, there's also been a lot of focus on mitigating cybercrime. Prior to the pandemic, a lot of the banks and counterparties that we work with had, quote unquote, cybercrime mitigating facilities. However, they were scattered and probably not focused on the various threats that we're currently seeing. So a lot of banks are responding to say that they indeed have strategies and have mitigating systems in place to ensure that they're able to provide fences and walls against these new risks that we're seeing as banks have become more open. This will also lead to my next point in terms of banks responding to increased regulations and operational requirements. We find that banks are increasingly focusing on ensuring that they have resilient operations. And this, again, is a big result of the shocks that we received with the pandemic, where a lot of the banks were found exposed to business contingency plans, working outside the norms. This, many banks actually still continuing with, where you find that, we still work from home, hybrid types of working. However, this also exposes banks to many other risks in terms of not being at the workplace, exposing their systems to APIs and other networks that were not there. So you find that banks are increasingly focusing on building operational resilience, ensuring that they have a disaster recovery plan, as well as business contingency and continuity plans. As I mentioned earlier, banks are also recovering from the effects of the pandemic, which led to a lot of shocks in the asset qualities. If you might recall, during the pandemic, a lot of the banks in East Africa, and I should mention that Kenya and probably Rwanda the most, had taken up measures to basically protect the banks from the contingent or rather exposed portfolios, and we had a lot of restructuring as well as moratorium. However, 2022 has seen a lot of these moratoriums falling off, as well as some of the openness that banks were provided to restructure their portfolios, either expiring or coming off. So you find that banks are now have to deal with the actual crystallized assets that had translated from either restructured or either the restructured book or those that were considered exposed. I've also, linked to strengthening operational resilience, there has been across the region a lot of either reinforced or new regulations with regards to operating in the new normal. And banks are increasingly exposed to increased compliance, as well as new or reinforced regulations from central banks, investors, as well as other stakeholders. So you find that there's increased scrutiny on banks, whether it's compliance or liquidity or the capital buffers. And most interesting is the fact that despite the fact that there's plenty of room for growth in local markets, but we also see banks moving away from, the organic growth that we were used to seeing, where banks are increasingly moving into more inorganic growth, and particularly so in Kenya. We've seen a lot of M&A activities where either banks are merging to basically reinforce their liquidity and capital buffers, or really just taking advantage of synergies. In Kenya, we've seen the merger of NIC as well as CBA to create NCBA. We've also seen KCB acquiring BPR in Rwanda, as well as equity going into the DRC. So this, in terms of outlook, is something that we expect to see a lot more of, as the bigger banks, the bigger regional banks. This also includes banks in Tanzania like CRDB, moving into either full acquisitions or mergers. And something that I really love to hear is, there has been and continues to be a big promotion on gender opportunities. This would either translate to an introduction of gender instruments or capacity building. And for the African Development Bank especially, we've seen more focus on the rollout of our affirmative finance action for women, where we have received a lot of response from potential partners in East Africa and actual partners. This includes the guarantees that are being offered by AGF in terms of offering either debt instruments or capacity building. We've also seen banks adopting gender strategies. In fact, okay, I'll quickly roll up. Yes, so quickly, in line with gender is also climate action. A lot of the banks have in place climate change strategies, as well as I'd say debt instruments that are being either in the process of being formalized or being rolled out. And quickly, the two are linked. What I've seen,
We can come back to it. We can come back to those.
All right.
Okay.
So my final point is that, and this is where I find a bit of challenge, is that there's been a sort of shift in demand in terms of the instruments that banks are requesting. This is probably something we had seen more in the market, the tier 2 markets that I had mentioned earlier, where there's a bigger demand for local currency financing, for local currency debt instruments, as well as banks sort of pulling back in terms of their demand for facilitation due to increased cost of pricing. Thank you very much.
No, thanks a lot. Thanks a lot. I'm sorry to rush you, but we don't have a lot of time. Thomas, please, your take on this.
Sure, I cannot agree more with everything that had been said. So when we talk about operational efficiency, that's always been a goal to every company and even a bank. So we saw that, with the black swan we had on COVID-19 or the gray rhino, that inflation right now. So this is kind of, how the capacity of banks to adapt, and this is the resilience. So this is kind of an oak versus reed kind of situation. In Africa, we have the benefit of not having such a huge legacy on the banking system. So we can adapt a little bit easier and leapfrog on all the topics that are already been mentioned. So let's think a few minutes on the environment that we already talked about it a little bit, so I'll go pretty fast on this. But, they had some global trend. Digitalization is on the pipeline for years. Now it just picked up really, really fast. And the counterbalance is cybersecurity, as we discussed. So financial inclusion, yes, important. Then you have this situation of NPL. How can we deal with this? And yes, ESG compliance. We have some also microeconomic issues that we're facing: COVID-19, the supply chain issue, inflation, and that's interesting is the response that some banks have regarding to all of this. But I strongly believe in the strengths that East Africa country has. So there's a young and large population. There's the global environment. So if you take DRC, for instance, I'm a little biased here, but we have the second largest tropical forest in the world. We have the Congo River, so we have so many assets we can build on. So the banking sector increased its savings enormously during the pandemic. So there's also an importance to do something with this cash and reinvest this into green bonds or more environment-friendly products. there's also all the needs of a growing middle class, and you know, Africa is also a growth driver for many international firms. So just to sum things up, so I really see banks as a business enabler role in the economy. So if you know, banks progress because their client progress, their base progress. So the more clients we have, the more transaction we generate, the more the better we are as banker to facilitate business, the more efficient it will be. And so the response is definitely so. Just food for thoughts on how to strengthen the operational resilience. So there's, I think, adopting agile methodology to be closer to markets is a great way to be more responsive and not you know, being like an oak inheriting for all the legacy of Europe, the US, on how to do business, but you know, think a little bit by ourselves with the needs of the continent. I think being curious on our environment also to, you know, study successes and failure, to be a constant learner, to think and anticipate on what we can optimize. Maybe that's not something that has not been done already. I think also to strengthen operational resilience, you can believe in the potential of the region and dedicate sufficient time, effort, energy, and money to make those thoughts a reality and then a success. Obviously, leveraging technology as much as possible is very important. This is a must-do right now. But you know, digitalization can be seen as a, you know, as a big word. Once again, in my view, this is just a tool. So the interesting thing is how we can use that tool to create value. And that's true on the front office side, on the back office side, and also on data analytics, open banking, and all the things, API I've been mentioned already. Investing on people. If you want to operational efficiency, you have to have efficient people that think straight, that are dedicated to the job, that are well equipped in terms of skills, competences, and tools. And also building a trust. I strongly believe in the platform model for the banking industry. We have fintechs, we are insurtech, we have all the regtechs, we got all this tech, you know, guys that are coming around. But what we have as banker is the trust from our clients. We have this really strong relationship. So if we have, you know, the best operational efficiency ever, but we don't have the right products to meet the demand. If you take the case of the DRC, we have between 6 and 12% of bank penetration rate. If you enlarge that to mobile, like access to financial tools, it goes to 30%. Is the reason is that because people don't need a bank, or is that because, you know, the offer doesn't meet the demand? I let that up to you. On my side, I think we just don't have the great demand here. But so I think it's you know, all this kind of ideas that you can, you know, tackle the problem from better understanding the market. Just try to think by ourselves on what are the best tools, the best products, the best services to tackle this kind of client. So having a very good segmentation, and as banks we can, with this trust, you know, bring all those good ideas of people who have the best tool-based services that we don't have. They are more agile, but we as a bank, we can, you know, be what we do best, is a business enabler.
Thank you. I'll move on to Benjamin. Benjamin, your take, please.
Thank you very much. Good morning, all. Allow me first to thank TDB, which has been our greatest partner in infrastructure development. And EIB has been supporting Bank of Kigali for SME finance and currently women finance. I won't discuss much about what my colleagues have talked about, the shocks that have characterized the last few years. COVID, which has shown the need of going digital. Now in Rwanda, if I take an example, This has helped for financial inclusion. We were around 78-79% financial inclusion. With COVID and the need of using digital transformation across all the institutions, we are now at 93%. But this has exposed again a weakness in our infrastructure. Most of the banks, we had legacy infrastructure, which needed to be upgraded to cope with the new demand, and a lot of pressure on this infrastructure because transactions had increased significantly. Again, there are new demands coming as a result of the new shocks like the Russia-Ukraine war. We see food shortage, then food security has become an imperative, and the banks, I think they can play a role in fulfilling this gap. We have an issue with oil prices going up. Countries are trying to build up strategic reserves. I think there is, again, here an opportunity. And maybe I will talk more about green finance, given the subject of the meeting. We have realized that there is a knowledge gap in the market as far as green finance is concerned. And one step that the Bank of Kigali Group has taken is to set up a foundation in charge of ESG. So because we think that we need to bridge the gap between the market and financial institutions and to tap into the potential as other presenters have talked about. So first of all, there is an opportunity to change the operations of our existing clients so that they can go green. This requires funding. That's one. Second, there is a need to train our own staff so that they understand the requirements of the moment. This is another opportunity, which is the market. We have seen regulations changing by government, where like importers of electrical cars in our market are exempted for duties. We have seen new changes coming to the market, how banks can bridge the gap and finance, fulfill the demand which is there. So I think there is a huge opportunity given the shocks that have revealed the weaknesses in the system, and as well to protect our earth. Coming back to the shock on food, we have now, the East African region is exposed to droughts and heavy rains from time to time. So how can we build resilience? So agriculture finance remains underserved, and we have many projects about irrigation and other areas to strengthen the agriculture sector. So there is a need really if we want to achieve operational resilience and be prepared for the new shocks, because all the current shocks have exposed financial institutions, even the economies in general, as being unprepared. So how can we increase our preparedness for future shocks? There is an investment required in health sector. So we have seen all these revealed by COVID and the other crises that banks need to be better prepared. So far we have been into infrastructure, as I mentioned before with TDB. We have been into SME finance, but green finance, will maybe invite partners here in the room. How can we tap into and champion this going forward so that we can build more resilient economies? Thank you.
Thanks a lot, Benjamin. I will now call on Mr. Habil Olaka, who is online. Please choose one of those issues and in your 6 minutes, please.
Yeah, thank you very much, Moderator. Indeed, I'm glad to be here today with you, though virtually. Now, going straight to the question that you posed, I would like to look at it from the perspective of fintech enabling financial inclusion and sort of like drawing the interplay with the regulation. And starting from, and of course, I'll be trying to give the picture from the Kenyan experience. And possibly starting from what Dr. Kasekende mentioned at the beginning. He was quoting the governor of the Central Bank of Kenya, and he mentioned some numbers in terms of the progress that you have made in terms of financial inclusion, where we were in 2006 and where we were in 2021, moving from 26 0.7% to 83.7%, which is quite some significant progress in terms of financial inclusion. And this progress has largely been driven by the new financial technology and innovations, and especially in mobile money and mobile banking. This is quite apparent from the report that was given by the FinAccess survey. Now, in Kenya, of course, banks have leveraged on the fintech anchored on the telecommunication-based mobile money services to roll out effective mobile banking services that are more cost-effective in delivery, of course, for their relative affordability and ease of accessibility. Now, if you compare mobile banking, of course, to the usual brick and mortar branches, we can talk about the fast, it's easy, it's convenient, secure, 24/7, and all the good things that the mobile banking provides over the brick and mortar, as we would say. Now, this, of course, has led to an explosion of services across these mobile banking platforms or mobile money platforms, whichever way we want to look at it. But so there's been an explosion in particular of digital credit providers. Now, when this happens, the next thing normally is the consumer protection, which becomes a major concern, and especially from the regulatory point of view. And so we saw a move where the central bank act was amended to provide, to give more powers to central bank to be able to license and oversight this segment, which was previously unregulated, that is the digital credit providers. So in particular, they were trying to address the issue of the high cost of credit that the digital credit providers were posing, the unethical debt collection practices, and up to an extent also the abuse of personal customer information. Of course, we normally notice that many fintechs across the world start off by offering basic payment services, but soon they expand into other services like wealth management, lending, insurance, and even sometimes deposit taking. Whereas you can see these benefits being accrued from the provision of the services they do give, they obviously potentially pose some risks to the preservation of the financial stability due to the ability to, for example, cause excessive indebtedness to the population, operational discontinuities, and the like. If you look at it from the fact that they provide services to the regulated financial institutions, such as, for example, cloud computing, you can see the vulnerabilities that are coming in terms of, for example, outages and the risks that therefore would be posed by such. If you look at it from the other perspective of the issuance of new means of payment, such as digital currencies, again, you can see the risks that will be posed by this. So the CBK Amendment Act of 2021, on digital lending, did provide some framework of how to license the governance and the lending practice of these digital service providers. It has also addressed a number of concerns to do with, for example, consumer protection, credit information sharing, addressing other customer risks, things like pricing and linking the price to the customer risk, things like anti-money laundering and countering financing of terrorism concerns. I think those are now being generally brought under regulatory torchlight. Now, I think while we celebrate the digital innovations, the disruptions that are caused by new technologies and the new products and the new providers of financial services, particularly the big tech companies, are known to pose some significant risks. And it's therefore important for there to be some regulatory guidance. However, in my view, that regulatory action should be subject to the principle of good regulation, under which public intervention should be minimized to what is essential to preserve social objectives, only to the extent that they contain risks, but not to limit delivery of valuable services and of course limiting innovations. And I cannot give a better example than illustrate the case of the M-Pesa in Kenya, because M-Pesa, you cannot talk about financial inclusion, fintech, without really talking about the M-Pesa. Because M-Pesa, if you look at what really happened, M-Pesa came into the market in 2007. The law that enables central bank to regulate M-Pesa, which is the NPS Act, the National Payment Systems Act, was enacted in 2014, 7 years after M-Pesa had been operating in the market. Now, without any regulatory framework, so to speak. And I think the regulator there adopted the approach of being fairly innovative, allow the innovation to prosper, assess the risks that emanate from the innovation, and use those developments to actually help you shape the law that will help regulate the framework. So, and no wonder, I think, in my view, M-Pesa has been so successful and has enabled the Kenyan financial system to be able to advance significantly on its financial inclusion agenda. And Chair, I think, let me pause there, and I could come back should there be a need to clarify or add on any comment.
Thanks a lot, Habil, and I think I'll start with you, actually. I want to link what Mkola said. I think we've just received an assurance that the banks are doing a lot in terms of adaptation. And we also want to use this also to learn from Kenya. And I think one issue that comes up is the issue you have touched on, incorporating pricing and consumer protection in a law without killing off innovation. I don't know whether you can tell us more as to the elements of this regulatory upgrade on pricing and consumer protection without killing innovation.
Yeah, I think I'll look at it from two perspectives, in the sense that if you look at the financial services in Kenya, we can look at those that are regulated under the Banking Act, which is really the banks. And for that, in terms of the pricing, there is a clear framework that has been brought in place to address the issue of pricing and linking it to the credit profile of the consumer. If you recall, in Kenya, we had a law that was really counterproductive in terms of limiting or putting a cap on the lending rates for the banking sector, which was repealed in 2019. And soon after that, Central Bank came up with a banking sector charter that tried to refocus the banking sector towards being consumer-centric. And one of them was to ensure that the price that is placed on a product is linked to the credit profile of the consumer rather than on anything else. And so the risk-based pricing framework has been really driven by the central bank. Now banks are expected to develop models that will show clearly the link between the credit profile of the borrower and the price that's placed on the product. And these models are approved by central bank before they can be put into use. And that is currently going on pretty well, I would say. Most of the banks have had their models approved, and so they are ready to roll out the model. Now, if you look at the other, what we can call previously unregulated lenders, and that is the one that now has been brought under the umbrella of what I mentioned a little bit earlier, the introduction of the digital credit providers regulations. And so with that, now central bank is able to sort of like bring them under some form of regulation, licensing, the governance, the lending practice of these digital credit providers is now under control. They're now putting in consumer protection issues and the like. Now, particularly about your question about pricing. Now, they would need to link the pricing to the customer risk and not just, provide a price that is completely not justifiable from a consumer, point of view. So in a way, then we are trying to achieve, a system where all credit providers in the market would be able to base it on the customer risk rather than, where it's just usury or exploitative to the customer.
Well, thanks a lot for that. I'll move on to Mkola. Back to you on these acquisitions, mergers, getting bigger institutions. The worry is always who are the orphans as banks become bigger, especially the bottom of a pyramid.
Just repeat the question, please.
Yeah, because some people may fall out of the financial system. They may not get access from the bigger institutions. As you talked a lot about institutions becoming bigger, their mergers, their acquisitions. But the small person, Mama Mboga somewhere, and is it something that you think about?
Thank you very much. So I'll speak for the mergers and the acquisitions that I've seen, and I'll speak by the change, or rather the adoption in strategies. As I'd said earlier, you find that most of these acquisitions that have happened are basically to leverage liquidity, capital, and as well as synergies. So if you'll allow me, let me speak of the NIC and the NCBA merger. Yes, much as it was for building capital buffers, building liquidity, meaning that they could do larger and probably more widespread risk transaction, it also meant leveraging synergies. So you'd find that NIC was primarily an SME bank. So with the merger, you find that the new formed bank has a bigger focus on SMEs. So becoming big does not necessarily mean that, basically, things fall out of the sieve. It basically means that you have bigger capacity to do more. And it could be more at the various tiered clients. And if you look at some of the acquisitions that have been made, it's really to leverage capabilities on the ground. Yeah. So if you look at the KCB BPR acquisition, it's really to leverage BPR's knowledge, capacity, and ability to serve the Rwandan market. Unfortunately, I mainly look at commercial banks and development banks and not MFIs. And therefore, I cannot speak for the Mama Mbogas within the scope of my portfolio. However, what I can say is that within my portfolio, you have banks that actually provide financing to MFIs. MFI is actually a big portfolio in most of the tier 1, tier 2 banks. And they would be served in these MFIs. Is that sufficient?
Yes.
Thank you very much.
Thanks. Let me ask both Thomas and Benjamin. I think what we've heard is that banks are responding to this environment. They are investing heavily. Will it make banking more expensive? What can we do, and what can we learn from the pricing model that Habil has just presented? Benjamin and Thomas, please.
Thank you very much.
Yes.
So what we have seen by using new technologies, going digital, actually banks are currently able to reach out to the market which was underserved. I will mention a few examples that I've seen in the market that we serve in Rwanda. We have come up with digital, we came up with short-term loans where clients can apply using their phones, and there is no need of a formal agreement rather than terms and conditions agreed upon by the borrower. And these are short-term, and we are able to support telco agents by giving them funds for buying the float. Currently, we have seen partnership between telcos and banks for smartphone financing. We have seen other small schemes where telco agents are coming with a scheme to finance a whole agent network so that these small agents can access funds. So basically, going digital is not increasing the cost. Rather, banks are able to reach out to a big number of clients and benefit from the economies of scale. So from the experience we have had, actually the outreach is much larger and the cost can be reduced. So financial inclusion, as mentioned earlier, is on the rise given the use of technology. And from my market where we really moved from 78 to 93, this shows that going digital, actually many clients will be served.
Thank you. Thomas, please jump in.
Sure. So the thing with the financial inclusion, it's one of the banking paradoxes that, you know, the good clients pay for bad clients. You're a good client to pay on time. You just have to cover for the bad clients who you just made the NPL of the bank grow. So just on that, the banks have to be very careful on building their client base. The banks need to be profitable because they need to reinject their benefits to reinforce their capital just to match all the regulatory ratio. So I think we must have some segments, so be very dedicated segment. At Rawbank, for instance, we're about to launch a dedicated team on the tier 3 SMEs. So we're going to have a dedicated team, dedicated processes, dedicated software just to tackle this kind of clients, because we think that the mindset of the other people we have at the bank doesn't really match for the mamas that we want to target. So that's one of the key takeaways. I got another one, but just I lost it right now.
There's hot pursuit. Mkola, please come in.
Yes, thank you. So basically, your question referred to the change in the pricing form, framework, particularly for Kenya, and this is the adoption of the risk-based pricing. As the CEO of the Kenya Bank Association had said that Kenya was mandated or directed to adopt the interest rate caps in 2016, of which the act was repealed last year. And what banks have been directed by the CPK is to adopt a risk-based pricing. So this basically means that the banks are no longer, basically price takers, and they've become more of pricing against the counterparty's risk. What I find is that this requires a lot of capacity building in terms of making customers understand why company ABC has X pricing because of its risk rating, whilst the company next door has a different pricing. So I think what would be required is a lot of sensitization, a lot of capacity building to ensure that clients understand what the framework requires, and this is basically pricing against the risk of the particular borrower.
Thank you, and yes.
Thank you so much, because that was exactly my point. Sorry, exactly what I want to say. So, but the thing, so financial inclusion is an investment, and as you mentioned, all the work we're doing with TDB and EIB on capacity building, training. We had a program with the IFC also, business ed, just to train, and we think that this financial inclusion is an investment. I strongly believe in the risk-based pricing. So thank you for putting that out.
Okay, thank you. They have just done an advert for MEFMI. We are in capacity building. Now I know which areas we might have to pick up. Now, this is your opportunity to ask the panel. I will not take very many questions, even for those who are online. Yes, already one hand. We will not take question by question. I'm going to take 3 questions, and I'll ask the panel to respond. Yes, a hand at the back. A microphone, please.
Hello. Yeah,
Yes.
My name is Pose. I have a question to Benjamin. I like when you mentioned that now Bank of Kigali is doing a lot in direction of women in business. And I have the same experience in Ghana with Access Bank. They have a special unit for women, and also in Vietnam. Where, do you think that women are in a better position to deal with the digital transformation than men? Sorry if I ask this kind of question. I see that the majority of people are men here. But I think it's really good to ask. Sometimes I have the impression that offering women the chance to do the transformation, SMEs, I am talking about your customers, yeah? That is much easier than with those older guys that are executive and sometimes very, they're thinking more in the past than in the future.
Thank you. Any other question for the panel?
Yes, thank you very much.
Yes,
one question that has come through from our online participants.
Yes, please.
I am Bahiru from Ethiopian Zamzam Bank. Mr. Benjamin, please share your experience on SME financing and women financing. Please say something on the modalities your bank uses for social financing. Thank you.
Thank you. We've got two questions, and since I'm not seeing any other hand, I want to throw it back, but starting with Benjamin. It's issues related to women and then SMEs. Please, have a go.
Thank you, Bosse, for the question. Actually, the first step we undertook was to segment the portfolio just to understand women-led business and to see the behavior. And it was encouraging to note that the default rate was much lower than men-run business. So that was encouraging. And what we have seen is the transparency and volunteering to share information about their business challenges and what they are going through. And actually some of the challenges coming from their partners, men, when they want to take money from the business, and we could see some of these challenges. So what we did, we put in place a program to support women with dedicated products, and these mainly were very short term because we selected some segment, trade and commerce. We took distributors of cement and those in trading of roofing materials. So what we saw was that the uptake was good and repayment was good. So the issue which we experienced was like when they want to scale up, getting collaterals, maybe trust from partners was not there to support the growth, but those are overcome with time. But short-term facilities were performing well, and investment, that's where we saw some challenges, getting the buy-in and collateral requirements. So currently what we are doing, we are partnering with one institution to get a portfolio guarantee so that the cost can be borne by the business without requiring to family assets, because we have seen many issues around pledging family assets as collateral to the business. Coming back on digital uptake, I can't say that we have registered much success. It's still in infancy, but COVID has helped to get to a certain point, but we don't see any differentiation between men-led business and women. So digital, I think we need more education and avail technology at no cost so that it can be enabling. So far, that's our experience for short term, and it has been successful. What we are engaging in, it's long term by supporting with risk sharing instruments to support these businesses. SME finance. So basically when we started as Bank of Kigali, we were mainly in corporate, and we found out with a study that there was a financing gap in the market around $1.7 billion for SMEs, and which was growing. So we undertook measures to have dedicated centers for SME. We opened up the first SME center where these SMEs were not mixed up with other clients, and we built capacity within our branch network. So we have been running seminars for these SMEs, because SME finance is not sufficient if you don't put together non-financial services. I think market linkage, financial education, product knowledge, and really empowering staff dealing with these SMEs so that they can understand. So capacity building has been two ways, internally within the bank and with our clients. So we have started up clubs where clients just meet for sharing information and understanding. We have a partnership with Africa Management Institute to train SMEs, and we have every month a group undergoing such training so that we can raise the level of awareness and opportunities in the market. So we started off 2 years back, but it's an ongoing program. And the most challenges we have seen was information and collateral side as well, I would say it is, because once we get a portfolio guarantee, then the risk profile changes. We're talking about risk-based pricing. Now we are even able to lower pricing for these SMEs, which were perceived to be much riskier. So far, that's what we have done under SME banking and women banking. Thank you.
Well, thank you. Given that we are almost running out of time, in case the panelists want to come back on this question, I want you to also combine it with your last word. So, Thomas, you want to come in on this issue of gender and the SMEs and the final word? Then I'll go around.
Sure. No, this is a very interesting topic. At Rawbank, we launched a program called Ladies First about 10 years ago with the help of the IFC. And that's a program that is very successful. And basically, we do exactly what you mentioned, that we finance women, we help them grow into the business. We did a training with the African Development Bank 1.5 years ago, just to constantly push this. The results are really good, where our portfolio is increasing. The level of NPL is really reasonable. We can definitely live with it. And it's a fantastic program, and it's really flagship for the bank. We really intend to do the same for this SME program I just talked about earlier. It's called SME 20,000. The issue we're facing is a lot of these companies are in the informal sector. The lack of business skills also creates a lot of problems on the quality of data. So we just try to, and we did that already, but to try to developing our own methodology just to better understand the financial profile of those companies, and then we just try to play with the information we have. And so we just kind of grow this expertise of trying to, make the figures understandable. And guarantees are also very important. We are working with the AGF on this. We have a guarantee on our SME portfolio, and we have a special threshold that is much higher for women entrepreneur and green projects. So that just gives us the possibility, and thanks to our partners, just to be a little more aggressive on this key sector that we want to address.
Thank you. Mkola, final word with the end of the two questions.
Thank you
want to come back.
Yes, thank you very much. So speaking very quickly, and here I want to basically, I'm sure you know what the African Development Bank is, but I just want to bring the point home in the sense that, Africa's, the financial sector development department of the AfDB mainly looks at financial deepening, financial broadening, and as well as financial inclusion. But it does this through working with partners. So we attend to cross-cutting issues, either through the bank's own debt instruments or initiatives. So speaking on the various initiatives, or rather the various cross-cutting issues that we've discussed today, we have either programs or initiatives that would look into this. Looking at SMEs, we have the Africa SME program that looks at providing either debt, capacity building, or risk mitigation instruments to tier 2, tier 3 banks who would on-lend these funds to SMEs. We also have the Affirmative Finance Action for Women, which is a program that looks to capacitate, or rather fill, the $45 million, billion gender gap, finance gap for women. And the AFAWA program / initiatives also looks at either providing debt, capacity building, as well as risk mitigation. And it also acts through partnerships, such as the AGF partnership that it has, where AGF deploys guarantees that are issued by AGF, through AGF, but from the AfDB and other partners that fund the AFAWA. And when we look at what it does on the broader side, all the transactions and instruments that the AfDB currently does are thematic. So whatever intervention that the AfDB does through a partner will have to serve a certain sector or theme. So we do more of, whether it's infrastructure lines of credit, infrastructure-based lines of credit, agriculture, but it's no longer, one size fits all or a generalist funding. The AfDB also, through the financial sector department, works with funds of funds, and this looks at alternative financiers. So the reason I'm saying this is that to bring this together, where we just we don't deploy one facility or one window to provide financing to the bottom of the pyramid. So again, I am at the regional office up in Upper Hill, and should you need to discuss partnering or collaborating with the financial sector departments, I am and the team that's on the ground are available at your convenience. Thank you very much.
Thanks a lot, Habil, Olaka, please, some reaction and last word, please.
Yes, maybe just the last word I could say that the discussion today has more or less highlighted the role that the fintechs play in terms of driving the financial inclusion and the very effective support to things like mobile banking, mobile money, and the like to achieve the financial inclusion. But of course, with it, we have also discussed the risks that come with the fintech, and therefore the role that then the regulation should bring in. And I think my last word would be the fact that this regulation is absolutely necessary, but it should be good regulation to ensure that we minimize the public intervention, to preserve the social objectives, but only to the extent that we are containing the risks. And with this, of course, we should then achieve a very balanced way of containing the risks, but at the same time, ensuring that we don't stifle innovation. So my parting shot would be that we should have an innovative approach to regulation that does not stifle innovation.
Well, thank you, and moderator, I know I've used up all my time, but I'll use up a minute. I think we've got assurances today that the banking system is adapting to this changing environment in quite an effective way, actually, and that the central banks are facilitators and partners in this adaptation. And I've liked this issue, especially for the bottom of the pyramid. It is not just debt, but it is debt and capacity building and risk mitigation. And don't forget the invite by our colleague Mkola from African Development Bank that she's ready to discuss this further and look for partnerships. And to all the other members of the panel, I say thank you, asante sana.
Thank you very much, our panel. Thank you so much for sharing those thoughts and that input. And Dr. Habil, online, asante sana as well.